But that doesn't necessarily mean there's not still deals out there. You just got to maybe go kiss a few more frogs.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Reed Goossens. Reed, how are you doing today?
Good, mate. Long time no see. How things?
Yeah, things are good. It's been a little while, not too long. I think we saw each other. Maybe it was in
Best
February at the best
Yeah.
ever. Yeah, good times. And you, Reed's been on the show. I should have looked the number episode up, but I bet it was, man. I mean, I'm around like 500 now. I bet you were on in like 150 or so.
That's insane.
It's been a while. So I thought it'd be fun to have you back on the show. A lot of stuff has changed. I'll give a short background about Reed, and then Reed, I'll let you kind of take it from there. So for those of you who don't remember, Reed moved from the U.S. from Australia in 2012 to pursue a career in structural engineering. How's that career going, by the way, in structural engineering?
It's long gone. Bye.
Yeah. So structural engineering to real estate investing. And with, your story is the guy who, came from a different country, limited funds, no credit, and then started buying, duplexes and growing this real estate company. And it's pretty impressive of what you've done. And so I guess really with that said, I don't want to belabor it because people can go back to the earlier episode, but why don't you take us maybe a little bit of background, but then kind of fast forward us to what you're doing right now, kind of the changes that you've gone through.
Yeah, man. Look, you're right. Moved here and the whole shtick is I had a curiosity that I wanted to scratch and just started going at it. Right. And I'm very fortunate to have a structural engineering background because it helped me get into corporate gigs that allowed me to grow my knowledge. I worked for big developers in New York City and in LA before I got my green card and could go full time with real estate investing. But, the message for me is like, if I can do it, so can the average American. And hopefully I've got some stories along this interview that I can share with people, little tidbits that help me keep the ball moving forward as you sort of build towards that entrepreneurial dream of being your own boss. But yeah, so I did start another company, which you know of, Wildhorn Capital, which we started that back in probably 16, 17. We bought a ton of deals. Good friend of mine, Andrew Campbell. We got to a point where we probably saw different visions, and I've now pivoted out of that company and starting sort of Reed Goossens 2.0, which is a company called RSN Property Group. It's always been around since the inception, but the last sort of 6 or 7 years have been under the Wildhorn flag. It's now under RSN and sort of going off in just a slightly different direction. And really the impetus to that was just to try and do deals in other markets, right? Offer a little bit of geographical diversification. And sometimes, partnerships are awesome and they're great when you start, but as you grow, they're like any human relationship. You evolve as individuals and you want different things in life, and that's okay as well. Like, it's like mom and dad still love each other, but you're better off apart. But we still remain good mates today, and it created an awesome foundation of what I've net worth wise, liquidity, all that sort of experience. But now it's sort of, as leading the ship in my sort of my own visionary role at RSN, it's now trying to take down deals in other markets and identify the key things that I've built, at Wildhorn and built in the portfolio and just applied in different parts of the country. So, yeah.
Love it. Why you guys were in Austin, Texas, mainly, some San Antonio as well.
Mm-hmm.
What was the decision or the reason to try different parts of the country? Was it just diversification, or what was there other reasons for it?
Well, I was getting on, I live in LA, for those people who don't know, I get on a plane all the time, right? I'm flying to Austin's 2.5, 3 hours.
Yeah.
You cover a lot of markets in that time. You know what I mean? Phoenix being one of them, always had my eye on Phoenix. Actually, before I went and started doing deals in San Antonio, I actually was heavily, this is back in 2015, was heavily looking in Phoenix, and probably should have started there because it's closer to my backyard. But,
Yep.
I just entered that market, just bought a deal in Mesa, Arizona earlier this year, and back in July. So got started. But again, just really trying to see different commonalities. There's a lot of companies who do what we do, based in New York City, LA, San Francisco, that do deals across the country. I'm no different. I guess also the lens of coming to America, having that, I've already come here, I already get on a plane. Like I can see the similarities in the different markets that I look at. So, if you walk a 1980s vintage building in San Antonio, Texas, okay, I know pretty much what the demographic is going to be if I see a Popeyes or a Sprint mobile store or Cricket mobile store. I can understand this, the structural element of the buildings because I'm just a structural engineer. That's what I know. And then you just look at the demographic, and that's all those metrics start to play out in different markets. And if you sort of going into growth markets, not that I'm not saying real estate is local, and I don't want to take that away from it, but as you're buying multifamily, the 4.5, 5 caps in San Antonio smell and look exactly the same in Texas, in Arizona, look exactly the same as in Florida, look exactly the same as in South Carolina. Like, you're buying probably with effective rents of $800-900. You're trying to push them to $1,300-1,400. You're probably buying at like a 4.5 cap. Again, my average demographic is going to be between $45,000 and $60,000 household incomes. The garden style, built in the 70s or 80s. I know the product they're going to buy. Some will have chillers, some will have individual HVAC, some will have aluminium wiring, some will need pigtailing. Like, it just all starts to like click, right? So that was really more the impetus to broaden the horizon a little bit.
That's cool. Since leaving Wildhorn, I know you've taken down a couple deals. What's your kind of take on the market? What's happening right now? I mean, a lot of people are a little nervous. I know there's some companies that are pencils down. There's a lot that are still trying to take advantage of whatever opportunity they feel they can find. Obviously, you're still buying deals. Let's talk about that. What's going on in the market in your mind, and why do you feel confident in still taking down deals?
I think this is a great time to take down deals because there's less competition, right? I've always been a guy that I don't just enter a market and be like, oh, I'm just going to go buy a deal in Phoenix, right? That doesn't happen. Like, I've spent, I thought, a long period of time underwriting deals in certain markets to get my to really get an understanding of what I'm buying, right? Am I buying it at a good price per pound? Am I buying? What are the expense ratios? Where's the rental trend going? Back to the sort of similar metrics that you use for any deal. So I think in general, as I've probably underwritten 40 or 50 deals in Phoenix and probably 30 or 40 deals in Greenville, South Carolina. And you just start getting like a sixth sense about what deals look like. You can quickly understand, okay, what's that? Yep. What do they want for it? Okay. What's the price per pound? Does it feel right? Does it smell right? Okay. What about, and then so if all that's still the same, and I can still, the fundamentals of real estate still remain the same. People are still looking for, affordable housing. Interest rates are going up, so less people are probably going to buy new homes, and then the cost of construction is going up as well. So new product is even harder to build. So I still think there's the fundamental element of the real estate is still very, very strong. But then couple that with people who get a little nervous that interest rates have gone crazy and it's unprecedented. But that doesn't necessarily mean there's not still deals out there. You just got to maybe go kiss a few more frogs. So for me, it's less competition and you're still getting to see more product and still believing in the underlying real estate.
Yeah, definitely. What are you looking for? What's a good deal? What are you looking for in a good deal?
I think what I mentioned earlier, buying, coming in, $850, $900 rents in place. You want to look at the average household income. I want it to be probably north of $70,000 a door. So when you do the math on like a third of that income can go to rent, Well, that's, that's well over $1,600 rents, right? They could afford if the in-place rents of a certain property are $800-900. Well, even if I bring them up to $1,200 or $1,300, which is a 30% increase, it's still well below what it cost, what the average person earns in that 1-2 mile radius. Or look at house prices. I want house prices to be north of $400,000, right? Again, because if you take a mortgage out on a $400,000 house, it's probably going to equate to roughly around a $1,300-1,400 mortgage payment, right? But habitual renters, people don't always have the time to save for those houses, so they want to live in good areas. And then the last thing is on the good areas of school districts. You want to be in good school districts. So household income, school districts, in-place rents are relatively low compared to what the average household income can afford. If all those sort of tick the box, then it's like, well, that's past the first litmus test. Let's look at the actual asset itself. What's going on with it? Why is it for sale? What are they trying to sell it for on a price per pound? Does that match up to what what I think the market is based on all my data that I've collected from underwriting other deals? And then what do I want to sell it for in 4 or 5 years' time? Do I believe the value is still going to be created? I'm picking up at a 4.5 cap today, and what's my exit cap rate? It's probably going to be a 5.5 cap rate, down in 5 years' time. So, being cautious. And then the other big thing is leverage, right? I think so many people have got burnt, and there's been retrades, and people going back to sellers. I was involved in a deal with, still with Wildhorn, that the deal blew up because the guy put it under contract, probably took too much leverage and couldn't raise the capital. My deal in Phoenix just recently, the bank offered me $27 million on, total, right, on the loan. I think that was roughly a 75% loan to cost or 80% loan to cost. I only underwrote to $25 million. So as interest rates started going up, it started chipping away at my proceeds. Well, I ended up closing that deal with actually $25.5 million, which was $500,000 more than what I needed. And there was no problem. So I think the gone are the days where you're going to come in with 80% on the purchase and then 100% capex. I've never underwritten to that, even from day one. I've always tried to underwrite, roughly around 65-70% on the purchase and maybe 75% on the capex. And the reason I do that is just you're raising more money, but then you've got more money to control if something goes wrong. You're not flying super close to the sun. So I think that's a good point. I mean, explain what you mean by you're not flying too close to the sun to our listeners, just so everybody grasps what you're saying. So when you're coming in and your interest rates are going to be, higher than what your cap rate is, right? And a lot of people have bought that, including myself, because you're adding value, right? Because again, go back to in-place rents. If my rents are at $800-900, my cap rate's going to be a certain rate compared to where I want to push it to when they're $1,300-1,400 rents. So there's a stabilized cap rate and an entrance cap rate. So when you have a disparity and say you're getting a 4.5 cap, but you get interest rates at 5, well, you're technically negative, right? So your cash flow is probably going to be negative coming out of the gate, or it's going to be very weak until you get your value add going. So if your leverage is super high, then that's a high barrier to jump on your debt service, right? So if you can lower that leverage down, it's a lower barrier to jump, which means it allows the property to cash flow easier, and you're not hamstrung by that high debt. So it all comes down to how you manage the cash flow. So it means you're probably raising money on capex. It means you're probably raising working capital account in terms of your raise. So it's money that will obviously lower the IRR, but you then don't take on as much proceeds, and that keeps you in a little bit safer position than someone who is at that 85-90% leverage and is like, oh my gosh, I can't even pay the debt because I'm coming in sort of in that upside down interest rates versus cap rates.
Yeah, that's so important, and that's something that I think a lot of, I don't know how many people do it, but I know it's happening where they're trying to leverage as high as they can, and they're putting in, the other thing I see, they're putting in the lowest amount of reserves as possible to try to push the IRR to make it look more attractive. And I don't know about you, but I mean, IRR sells to an extent, but it really doesn't. As if I present an IRR of 15 to my investors versus an IRR of 18, I'm not going to fill the 18 that much faster. It's just not going to happen.
Interesting.
I don't know if you feel the same way or not, but my investors are looking for, they're trusting what my judgment is, right? And I'm sure your investors are trusting your judgment, how you operate your business. And if you're flying closer to the sun, as you said, that's going to take away some of that trust. And eventually it's going to burn you. And that's really going to ruin your trust. So I would rather have lower looking IRR than trying to push it really hard.
No, that's exactly right. And the other things you can do that people have done in the past historically, and I'm not saying recently, but maybe go back 3 or 4 years ago, they were doing refis come year 3, right? I think if you see a refi in a calculation, don't like run the other way. I'm not saying that's because if you're buying an asset that is 90% full today and it's medium to light value add, you aren't going to create 50% value to then go and pay off 60% of your investors. The max I've seen in my deals is maybe 10 to 15% on a refi that you could give back in terms of equity give back, maybe 20% on the high end if you do a really good job. Again, if it's already stable, it's already somewhat cash flowing, it's hard to then push it that next level. A little rule of thumb that I always look at is, do I believe in the 50% valuation growth? So if I'm buying an asset at 100K a door, do I believe I can sell it for 150 a door, in 5 years' time? So 10% growth a year. So again, if you're going back to that adage of someone's going to come and take out 80% of equity come year 3, well, how much have they got to push that value to get that 80% pull out, knowing the bank won't give them $1 on every value that they create? Right. Yeah. So it goes back to the overall vision of like, well, what does this operator think I'm going to be able to push the value over a 5-year period? And, I've underwritten thousands of deals. Rule of thumb is roughly a 50% value. So if I'm buying it 200K a door, selling it 300K a door. If I'm buying it, 70K a door, I'm selling it 140K a door. Like that sort of, I know I can back into a mid 15 IRR return for my investors. And if I believe that on a exit cap rate expansion of 100 points, then I feel good about, and I believe in my growth in the rent, then I know I can hit that mid-teen IRR and I don't need to refi. I don't need to put any extra stress on the property. I don't need to go get too much leverage, and I can just be straight down the fairway. And to your point, an investor swallowing a 14 or a 15% IRR when they have that trust in an operator like you or myself versus a 17, 18 IRR and they've got the refis in there and the 80% leverage, that's what's like, oh, that's a little scary. So
yeah, the fairway got me thinking of golf, right? It's the you're gonna swing for the fences, you're gonna hit that ball and you're gonna smash that thing and it's gonna go 300 yards. But I don't know if it's gonna hook or slice or what's going to happen to it. That thing might go straight down the fairway, but it might go left, right, or just right into the drink. Where if you just pull up a little bit and just give a nice steady swing, it's only going 225, but it's going to be right down the fairway.
Right. That's exactly right.
Love it. And I'm not a golfer, so
neither am I. Thank gosh. Thank another person who's not a golfer. I'm a hack at the best of times.
Me too. So you're with Wildhorn now, RSN. Obviously I'm not asking you to throw Wildhorn out of the bus because you built that company. You like the company, the guys still. And so I'm not asking you that, but what I'm asking you is you've learned lessons along the way and you guys started off green. I mean, when you guys both started your first deal together, I mean, right?
So green,
big deal, right? Super green. I mean, and again, listeners can go back and hear both Andrew and you on the podcast and listen to the story. So, but my question is, you've learned a lot of lessons. You took a lot of bumps and bruises. What are you doing, knowing those lessons now? What are you doing differently this time? Maybe I'm sure you're doing many things differently, but what are you doing this time to, I guess, it's not really starting, right? Because you're doing the same thing, just different, but how are you building it differently this time? Maybe some lessons that you took.
Look, I think in the beginning, if you break it down to what partnerships happen in the beginning, right? Both Andrew and I were working full time when we met each other.
Yeah.
I didn't quit my day job until we had I'd led 4 syndications.
It was 4. Wow.
4. And then that was coinciding with my green card and everything. But the reason you do that is because you're not just sitting on a wad of cash to go out and hire people. Now, as I've got a few runs on the board and got some money in the bank, I can go hire those good team members, and I'm letting go of that vine a little quicker. So that's what the control part of sort of investment, operator, chief investment operator, and always making sure that we're checking the deals and making sure they're right, but bringing on team members that can help me run at a different pace. I remember interviewing Brandon Turner on my show, and he talked about sort of like the 4 steps of becoming your better self. And he talked about DIY, right? When you get your first house, you're probably changing the toilet and doing paint. And then you go to project manager. You maybe overseeing the GC, and then you got chief operating officer, right? Which that was really where I was with Wildon. Even though I founded it, I was a chief operating officer. Then you have the architect, and I needed to transition from that chief operating officer to the architect. And that was just, sometimes you need to go buy your own ranch, if that that makes sense. So there was no malice, or it was tough to say I got to walk away, but it was also, I know in 10 years time I'll look back and say that was a really awesome decision, and we've still maintained a friendship and learned a ton of lessons. Again, go back to built the net worth, built the experience together, and now I can go off and do the dreams I want to do, go to the markets I want to go to, and that's okay. Like the thing, so many people think that the partnership or the breakup is bad, but it's just ultimately we're evolving as human beings, and that's, you succumb to that expectation, things, all the anxiety melts away. It's completely fine. So
love it. What's you guys did a ton of deals, and you're still doing deals, whether it's with Wildhorn, whether it's now, whether it's even before Wildhorn. One of a couple big lessons that you've learned that, maybe you look back at and you laugh and go, but what are some of those big lessons that you learned? Maybe we'll start with one, I guess. Maybe we'll dive into a couple.
Yeah, look, I wrote an article about this when we sold the Joseph, which was the first ever deal Andrew and I did. I vividly remember the ups and downs of that late 2016, early 2017, just sleepless nights, equity. I still have those to this day. Don't get me wrong. It doesn't never come easy, but looking back, we did and it's interesting for interest rate environment. So I think it's really topical for today. So back in late 2016, if people don't remember, interest rates were thinking they were going to the moon. We were able to get a Freddie Mac loan on the deal. But it had defeasance on it. So even when we sold that deal, we only sold that deal end of last year, early this year, end of last year. We still had over $1 million. We're 6 years into this deal. We're still $1 million in defeasance because we locked it. Now, we locked it to raise the money because, so think of the other side of the coin. We locked it with, hey, investors, we don't have interest rate risk. And we locked it at a 4.4% interest rate back in 2016, 17. We could have probably sold that deal 3 or 4 times over, given where the interest rates went. Now, with defeasance, they set that floor. You don't go down. Like you ain't, so we're overpaying for stuff like that. So that was a lesson. And I always remember the debt broker saying, dude, guys, go for the floating rate Freddie. It's fine. Like everyone does it. You'll be able to get out of it, in 3 years time, you'd be great.
But you were too nervous with where you thought the market was. So if you thought if we go floating, we're going to be paying 6%.
Right. Right.
And so you went with
does it feel like today?
It's funny because it really does. I remember during that time, I was looking at a deal and I ended up not going with it because, again, the interest rates were going high and I was thinking they were just going to go higher by the time I locked in. So I forgot to relook at that deal as interest rates really skyrocketed down and should have relooked because, man, but yeah, it just feels a lot similar.
It does feel a lot similar today. So what does that mean for the lessons learned? Well, I'm getting more flexibility on my back end. So I just we've done, Bridge has been the product that everyone has been doing for the last 2 or 3 years. I'm now going to a fixed rate local bank at 5%. That feels good at a 65% leverage. Again, not too high. It feels like I can really jump that hurdle, and allows me no prepay, no defeasance. It allows me to then refi, even though I'm not refining, I'm not putting in the calculations, but with the 65% and a confidence in mind where I'm going to push this deal to, I think in 2 to 4 years time, I think interest rates will come back down, and I'll be able to go get something, at a minimum, I'll be able to replace the 65% at today's rate, knowing that in 3 years time, I'll probably push the value 30%.
Or you can sell without any
penalty. I can sell. Or I'm buying two, so I can sell one, keep the other. Yeah. So there's just different lessons there. On another deal, the first deal we did in Austin, we did a very similar thing, but it was I forget the name. It was like a hedge. It was a local bank, but we got and I'm going to forget the name of it. And it was so it had to always stay at the 5%. So I saw every week the hedge that I got on it would increase so the bank's interest rates would go down, and I'd see on my but the hedge would keep getting more expensive because I had to keep it at that 5%. And there was some months that it was just like, I'm paying $60,000, $70,000 in this freaking hedge, and wow, that's pure cash flow to investors. It just, you do it to lock in your risk, and I get it. But looking back, that was probably a pretty big, I don't want to say it was a mistake, because it didn't burn us, which is a good thing. But it was something that we probably could have done a little easier. And the reason I say that is because as syndicators, the biggest thing is you're growing a company, as we grew Wildhorn, as I'm growing RSN, will be, what are your exits? Well, the first deal we did, we locked it in for 7 years. We knew we weren't going to sell. We couldn't sell. But if we had the floating on it, we would have been able to probably sell it sooner, get that run on the board, show the investor. It just helped the story as you grow a syndication company. For the individual investors on that deal, they did just fine. They got a 18, 19% IRR, and they're loving it. So
why sell? Why are you selling your properties? Why don't you hold them for a long period of time?
The way I structure my deals is that I get compensated once we sell, right? I have a pref in there. 9 times out of 10, those prefs throughout the hold aren't really met unless you got your Class A, Class B set up, which we do. But I'm eating last, so it makes sense for me to sell. And if you look at the average hold period of the deals we have sold, it's about 36 months, maybe 3.5 years. And so again, back to the business of syndication versus the individual deal, you then offer that investor or investors the opportunity to roll into another deal. So they're still having that cake and eating it too. They're still keeping in real estate. Their basis is now just, they've grown their basis. So for me as an operator, it is about, I profit and it's selfish, but if I'm profiting, everyone else is profiting and they're doing really, really well. Like, because I eat last, I am the last guy to eat. Well, there could be deals that you sell that you pay off investors, you give them their pref, and there's no profit left. Well, guess who doesn't eat? Me. Now, I'm not saying I'm in that business to do that, and that's the risk I take. But the reason why we sell at a certain period of time is because of that. Now, that moving forward, that has been the adage for the last 3-5 years. Moving forward, I've set myself up that I can keep holding for if the markets turn to crap and we can hold for longer than 5 years. I always will model a 5-year hold, but you always have the opportunity to be flexible with your exits and stick your head out and say, who wants to buy it at this point? And, it's again, another run on the board. It helps investors get more confidence in you, and you give them back their money. There will come deals that I know that we'll hold for a longer period of time. It just, and probably now we're coming into that next sort of 5 to 7 years is probably that time.
Yeah, I see that potentially happening. Of course, who knows? I mean, everybody has a prediction and they'll all be wrong.
Right.
So who knows what's going to happen exactly? But yeah, you're probably right. There will be a time where it doesn't make as much sense to sell in 24 to 36 months, where it makes a lot more sense to hold for 5 to 7, even maybe 8-10 years. So
yeah, I'm definitely not I don't think the way my deals are structured, anything sold within a 24-month period. That's like, I'm just not structured that way. The minimums would be 3.5 years sort of stuff, so it's probably going to push up towards that, more back to everything's going to be a 5-year cycle now, 6-year cycle. So, yeah.
let's talk raising capital. You've been obviously pretty successful with raising capital. You guys have closed a lot of deals. You're purchasing, you just purchased a deal in Mesa, I believe you said, and then you're purchasing a deal in or two deals in Greenville.
That's it. Yep.
What are some of the, somebody who's like, hey, I want to syndicate, or this is interesting to me. What are some of the, let's go even, let's not, I guess let's go deeper than that. Let's talk about somebody who's they've read the books. They know the basics. Like where would you point them? How do you get really good at raising money? How do you find the investor, I guess?
If you find out the answer to that question, let me know. I'm still, no, and I say that facetiously. Every deal, even to this day, gives me some sort of, like, I'm not going out and putting 3 deals under contract. Like, I'm not raising a fund. I've done it the bootstrap way, the same way as you've done it. And I look at deals and I back into what can I raise, right?
Yeah.
So I'm doing deal sizes, knowing I can raise on that money through me and my co-GPs, right? That's how the business works. I want to go out and buy $70 million, $80 million deals. And we've done that with at Wildhorn and bought in some private equity. But right now, as you're sort of read Goossens 2.0, right now, it's just like back into the things that I know I can raise on. So the Phoenix deal, for example, is a $33 million deal, $32.5 million deal. It was about a $13.5 million raise. I ended up only needing about 12.8 of it, but I knew 12.8, it's a good number I can hit, right? Today in Greenville, we're $15.5 to $60 million. It's a little bit on the high end for me, but I'm not going to lie. It's about a $35 million deal. That gives me a little bit of pause, but we're actually filling that up quicker than what I thought I was going to fill it up. So I'm backing into deals that I know I'm comfortable with. I think as we get to the $20-ish million mark, I'm just like, no, I'm not. I can't. If you really put a gun to my head, it's sort of the $9 to $15 million range. That's a sweet spot of equity. And that will then translate into probably a $25 to $35 million, $36 million deal. So
Yep. Where are you finding your investors?
Same way, podcast. I've got a podcast that I've been going for 7 years now, investing in US books, putting my face out there. I'm really, one of the things I'm doing now read Goossens 2.0 is like, I've spent a lot of time with the brand. My name is the brand. I think that's important because people trust and like you. In the beginning, when you ask for that first $100,000, they're investing in you as the person, not necessarily the deal. The deal is important, but they're investing in you because they trust you. So
especially somebody that's new.
That's right. Especially someone that is new. So when I started the podcast talking about my journey. I started the story. It's all about the branding. It takes years to build this up, but I've now got to a point where I'm like, I believe I've got a bit of a trusted name in my investor space that people are like, I trust him, right? Now that trust takes a long time to build up. It can be lost in an instant.
Yeah.
But doing it through the podcasting, through the books, doing exactly the same thing that you've been doing, just slowly chipping away at it. I know there's a saying in cricket called line and length. When you bowl the ball at the batter, you want to be hitting the ground and then coming off and getting a good line and a length to the wicket. And you keep bowling that over and over again, you'll eventually get them out. And that's what this business is. It is not some people who are freaks and can just start raise $3 million in one email. That takes years to build up. Like I look at email guys, and we know all the guys who do that, and it's good on them. But they've either one, spent a ton of money on marketing, or two, just have a really awesome network. I think the guys who are more successful out of the gate straight away are the guys with, the bigger networks. People like you and me, we've got to keep chipping away at the marketing side of it, the line and length, analogy, to just keep growing the database. So today, I'm the first 2 deals coming out of Wildhorn, 5 or 6C. I want to test the Facebook marketing stuff. I've got content out there that's already been out there for many, many years. Why not? Let's go try it.
Did you do the 506C for that Mesa deal?
Mm-hmm.
Yeah. How did that go? Did you like doing the 506C? Did you get reception from it or no?
I got reception from it. Did I get investors from it? Probably not. I got a handful. but that's not the point. The point is to be in front of people.
Yeah.
Right. You saw it. Other people saw it. I'm top of mind. This deal now, I've got a bunch of people who've come through, and I'm not talking a couple $100,000, like well over $1 million, I think, on this deal has come from literally people who I've spoken to not even 4 or 5 times, like once after they saw a Facebook ad. Now, I'm not saying, please hear me right, I'm not saying that if you're a newbie investor to go out and start advertising on Facebook. Yeah, I have spent many, many years with the book, with the podcast, with the brand building to get to that point. Yeah. And now I've got people on my team that make that process from email to onboarding to the look and feel of it all, the videography that we do, if you know that needs still work. That's not just like you snap your fingers and that comes to life. It's taken a lot of time to get to that point. I think it will continue to grow. I think it's more of an investment now than it is a turn on the lights or open the floodgates and it's coming through. It isn't that, but it probably could get there if you spent more money and more marketing dollars on it. It just depends on how hard you want to go. And that's probably the biggest lesson I've learned when you see the Grant Cardones or the Brandon Turners or the guys who are raising big dollars online. You look at their history, they've had years of content to build that trust, to then go out and ask, to then say, hey, let's do a 5 or 6C. And I'm, they're at a 10, I'm at a 4. So just slowly chipping away at it.
Yeah. I would echo exactly what you said though, about if you're newer and you're thinking, well, I'm going to put myself out there online. I see all these guys and gals that are advertising their deals and they got to be getting buckets full of money. It's not the case.
Not the case.
The first time you do it, like you said, you did it. You have a track record. You're a known entity. You have your podcast. You've been around for a long time. People see you. They already have some name recognition and it's easier for them to invest. But had they never heard about you, you might get some leads, but they're likely not investing in your deal. So if you're going to go out there and you're going to raise 506C money and you're a newer investor, my piece of advice or my thought behind that is you're probably going to raise about $0 out of that 506C. But like you said, it's going to help you moving forward. It's going to strengthen your brand. You're getting your name out there. It's name recognition. It's all about getting yourself out there. And eventually 2 or 3 or 4 deals down the road, you're going to be raising some good money from that. But don't assume that Facebook's or LinkedIn or any of those
is just, printing money. It's not.
It's not coming.
It's not coming now. Right.
Now,
I was talking to Ben, my new business partner, sort of the COO, and he's been handling all that back end for me. I know Facebook ads work. Like people have raised money. Like I want to scratch that itch. If it doesn't work, I'll pull it.
Yeah.
But he was like, "Oh, do you want to do 5 or 6C now?" And I was like, "I do because I want to show the wider community that it's coming again, right?" So again, it's not you're paying for the 2 inches in your head. Oh, I see him again. Okay, he's got another deal out. Okay, great. What's this deal about? It's that helps keep the momentum going. And momentum is really important. I remember a good friend of mine, Omar Khan. He talks about momentum a lot as well. Momentum breeds, not hysteria, but just breeds more people wanting to come into the sphere. And how you use the online marketing is a momentum builder, if that makes sense.
No, it's a good point. If you do it once and that's it, and you never do it again, you didn't gain anything. You just wasted your time and money.
You literally pissed it all away.
Yeah, that's like if you went on to one podcast ever, did one podcast episode on your own podcast
one time,
it's worthless.
That's right. That's right. So everyone listening today, it's all about consistency, right?
Love it. All right, Reed, we gotta wrap up, man. I got so many more questions I kind of want to ask you, but maybe
shoot, man, we have to do 2.0.
We'll have to do 2.0. Well, let me ask you this. I ask this to everybody. I asked you this before, but it's been a couple of years, like we said. What's a favorite book that you can pass on to our listeners?
Favorite book that I'd recommend, it's non-real estate, but about probably the theme of what this show is all about is Key Person of Influence by Dan Priestley. I've actually interviewed him on my show. He's an Australian author. And it talks about the power of exactly what we're doing here. What you've built, Todd, what I built is creating yourself as a KPI, a key person of influence in your sphere. You do not have to be the next Tony Robbins, but you, in the people that you know, if you had 1,000 followers that really loved everything that you do through creating content, through podcasting, through books, through blogging, through whatever it is, that you're going to be able to grow your business. And the premise of this book is all about, you could be a dentist, you could be a doctor, you could be a lawyer, you could be a real estate investor. You put out the content in a methodical, thoughtful way that helps build other people's education around what you do. You could be a painter, for crying out loud. You could be anything. It will help 10x your business. So Key Person of Influence is a really important book for those people as a sort of a segue from this conversation.
Love it. Reed, what are your 3 pillars of wealth creation?
In the business or just in life?
So
my 3 pillars are going to be, so there is business, there's health, and then there's, I like to call sort of love. You can put religion or you can put whatever. I remember doing a show after my mum passed away in 2017. I talked about the difference between priorities and goals. And so many people I've interviewed, probably you're the same way, Todd, that they're super successful in one of the pillars, right? Business, right? They put all the energy, and I've been guilty of this myself.
Yeah.
But if you don't invest in your health or your family, your loved ones, having people around you, like my wife and about to have a kid, that's what we do it all for. And sometimes as we're climbing that mountain, we do get looking too far at the goal and not realizing what are our priorities in life. Because if that one pillar goes away and you only have one pillar, the only way you're going to go is down. So having those 3, so in mine, it's wealth through the business, but it's also wealth through my health. I get a lot of kickback out of being physical every day. I need to do it. Meditation. If I don't meditate every morning, my day's screwed. And then my family is really important to me. I come from a strong family, and the whole reason I got into this business is to create more time for them. So that's my sort of pillars of wealth in and around other things in life, because it's so important not just to be so focused on the one thing that creates you that freedom.
Yeah. Love it, man. Love it. Love it. It's so easy to get caught up in one, right? And for most of us listening, it's the business part, it's the wealth creation part, it's the money part, but there's so much to wealth beyond just the money, the dollars. Like you said it so well. I mean, the business, but the love, the health, there's so much more. So I love that. And it's just easy to get distracted, not to get distracted, to go like laser focus on one and forget the others.
And I will say, hand up, I've been guilty of it.
Yeah.
Been guilty of it.
Included.
So, and you have to go there to know what you just, when things happen in life, like the passing of my mum those 5 years ago, I was like, whoa, what the fuck? What am I doing? You gotta, it could be all over like that. And you've been put, so don't want to get too into that, but it's really important. And I'm glad you asked that question, because it makes you a rounded entrepreneur.
Love it. Reed, look, man, really appreciate the time. Congrats on the new baby coming.
Thank you.
That's super
I'm
exciting.
nervous. Nervous.
That's good. Congrats on the new company, RSN.
Thank you.
Wish you all the best. How can our listeners get in touch with you to learn more about what you got going on? You got books, you got all kinds of stuff. How can they learn more?
Easiest way is to go to just reedgoossens.com. That's reedgoossens.com. You can check out all the educational stuff. There's links to, if you want to invest with me. And also, if you're ever coming through Los Angeles, you want to catch up for a beer or a coffee, just to talk, talk some shop, you can hit me up at info, that's info at reedgoossens.com.
I got to ask you, Reed, you live in LA, but you do no business in LA. Why are you living in LA?
I surf. That's the two things.
It.
My wife's from here, and
that's a big.
I surf. I surf, and it's also one direct flight back to Australia. So it's like there's a couple of reasons. I was heavily considering moving to Texas at one stage a couple of years back, and I was like, I love surfing too much. Like, look at Tide's equities, look at Ashcroft Capital. They're in New York and LA, and they get it done. So why can't I? So
love it. Love it, man. All right. Well, you have a fantastic rest of the day, man. Take care.
Thanks, man.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.